How in the world can a company with a massive fleet of modern ships, trading at literally half its book value, be labeled significantly overvalued by one top analyst, while simultaneously being called a classic cigar butt by value investors? Well, welcome to today's Explainer, where we're jumping right into the incredibly bizarre, totally contradictory world of microcap shipping. Specifically, we're putting Pyxis tankers under the microscope. We really have to ask, is this tiny microcap stock a hidden gem just waiting to be uncovered, or are we looking at a financial disaster in the making? The contrast in expert opinions here is absolutely stark, and we are going to get to the bottom of it.
So here is the core contradiction. On one hand, you've got what looks like the ultimate value investor's dream, right? A company with a massive, modern fleet and a microscopic price-to-book ratio of just 0.51. I mean, the asset value alone tells you this thing is an absolute steal. But the earnings quality tells a completely different story. We are talking about a jaw-dropping 94% profit crash, which has actually led some experts to call the stock significantly overvalued and a total cigar butt.
To make sure we cover all the points and solve this mystery, here's our roadmap for this explainer. First, the paradox, then the red flags, followed by the hidden green flags. After that, we run the stock through the guru gauntlet, and finally, we'll arrive at the cyclical verdict.
Part 1. The Paradox, a Microcap Mystery.
Part 2. 4 massive red flags.
All right, let's get right into a rapid-fire overview of the bear case against Pyxis tankers. The prosecution is basically bringing 4 major charges that threaten the company's survival. We've got the earnings cliff, the debt trap, the fake moat, and a pretty glaring overvaluation. Let's look at the evidence.
Okay, so let's dive into this first one. Profitability has suffered a frankly terrifying 94% collapse. Back in 2023, they were absolutely printing money, bringing in $37 million in net income. But by 2024, that plummeted to $12.8 million. And if we look at the trailing 12 months, it's a measly $1.9 million. And to make matters even worse, management has actually openly admitted they expect this brutal charter environment to just keep going. So, this isn't just a minor speed bump for them. This is a full-on cyclical freefall.
Which brings us to the second red flag, and this is a number a lot of analysts just skip right over, the debt trap. Pyxis Tankers has an interest coverage ratio of just 1.39x. Basically, that means their operating profits barely cover the interest payments on their debt even once. If shipping rates stay this low, they are getting dangerously close to failing to service their loans entirely. Red flag number 3 is what we call the fake moat. You're going to see a lot of media outlets praising their modern, eco-friendly vessels like it's this massive competitive edge. But if you actually check the Guru Focus Moat score, they get a flat 0 out of 10. Why? Well, because an eco-friendly tanker is really just a commodity. Any competitor with a big enough checkbook can just go out and buy the exact same ship. There is zero brand loyalty, no switching costs, and absolutely no pricing power in this market.
And finally, the fourth red flag, the valuation. Even though they have that dirt cheap price-to-book ratio, Guru Focus calculates their actual fair value at just $3.45 per share when you base it on projected earnings. So ironically enough, a stock with a 0.5 price-to-book ratio is technically 30% overvalued right now. Crazy, right?
Part 3. Hidden green flag catalysts.
Now yes, the earnings are crashing, but let's slow down a second and pivot to the defense. The bull case for Pyxis actually rests on a foundation of hard, undeniable metrics that short sellers are completely ignoring. We're going to look at 4 key defenses: how this company is a literal cash flow monster, the deep asset discount, a stealth hedge property, and some massive insider buying.
First up, despite those terrifying accounting losses we just talked about, this business is an engine that is still printing hard cash. They are sitting on an astonishing 35.5% free cash flow margin. Right now, they're generating $1.19 per share in free cash flow, giving them a price-to-free cash flow ratio of roughly 4x. I mean, in a market where the S&P 500 routinely trades at 25 times earnings, finding a 4x cash flow stock is incredibly rare.
And here is the really crucial point. You are essentially buying $1 of tangible assets for 51 cents. With that price-to-book ratio of 0.51, you are literally buying physical ships that could be sold for scrap or rechartered at half price. In the shipping industry, when the cycle inevitably turns, that massive discount spread can tighten violently in favor of the shareholders.
Green flag number 3 is the stealth hedge. Here is a neat little statistic the broader media completely misses. Pyxis Tankers has a 5-year beta of -0.52. That means this stock fundamentally moves in the opposite direction of the broader stock market. So if the S&P 500 crashes, Pyxis acts as a portfolio diversifier. It actually has a statistical tendency to rise when everything else falls.
And honestly, look at exactly who is betting on this company. Nearly 60% of the stock is held by insiders. On top of that, management is actively shrinking the share count with buybacks. They aren't running for the exits, they are actually betting their own net worth on a massive recovery.
Part 4. The Wall Street Guru Gauntlet.
Let's see how all this builds when we run this conflicting data through a gauntlet of legendary investing frameworks. Let's see who's actually right. Benjamin Graham, the father of value investing, well, he might initially love that 0.51 price to book, but he demands positive net current asset value. Pyxis essentially has 0, and their Graham number is wildly unstable, prompting his framework to say, tread carefully. Peter Lynch, the growth guy, he focuses on the PEG ratio. With negative growth and a PEG of negative 0.19, he absolutely hates the boom and bust tanker rates and says absolutely not. And finally, Warren Buffett. He looks for moats, high returns on invested capital, and low debt. Pyxis has 0 moat, a dismal 2.6% ROIC, and a dangerous debt-to-EBITDA ratio of 5.3. Buffett's verdict? Wouldn't touch this.
Part 5. The Cyclical Final Verdict. Now, what's really interesting about this is it summarizes the ultimate paradox perfectly. Pyxis Tankers is undeniably a low-quality business. It has no moat, it operates in a brutally competitive industry, and it struggles with super shaky earnings. Yet, at the exact same time, it is sitting on enormously discounted cash-generating physical assets. And this proves exactly why traditional value metrics totally fail here. The media will tell you this is a cheap stock, but you know what? It's not a traditional stock at all. It's a pure cyclical bet. Your returns here aren't dictated by corporate fundamentals. They are dictated entirely by the macroeconomic swings of global crude oil and shipping demand.
And that brings us to the ultimate climactic question. Literally the only variable that actually matters for this entire explainer. I really want you to think about this for a second. Is the global shipping cycle going to turn upward within the next 12 to 24 months? Because that single macro event is the absolute decider of this stock's fate, nothing else.
If your answer is yes, if global shipping rates spike, the earnings explode, that dangerous debt gets paid down, and that tiny 0.5 price-to-book ratio could easily double or even triple. But if your answer is no, if rates stay depressed, the stock will just drift. The interest coverage fails, the debt trap closes in, and you are left holding a classic value trap. Graham says maybe, Lynch says no, and Buffett says hell no. Because at the end of the day, you aren't really betting on Pyxis Tankers. You're betting on the price of crude oil. The only question left is, which side of the cycle are you on?